Some parts of this market now, Greg, pricing in a rate cut as soon as 2023 from the Fed. We know a lot of people have moved into cash as dry powder amid this uncertainty. Is that the trigger point? Is that what investors should be looking for to get more exposure to equities?
You know, I think we always argue that investors should be diversified, be balanced, and thinking about the long term. So there's always going to be periods in markets where you're going to see some volatility like we saw at the beginning of this year. And so for us, we try to tell our investors, stay focused on the long term, whether or not that means saving for retirement, saving for a house, your kids' college education, but do it in a diversified, low-cost manner. And to the extent that you have your portfolio that gets out of line because of, a major drawdown in equities, rebalance back into that to keep your allocation proper.
Greg, I think you're expecting, though, interest rates to be at 4% in the next 18 months if the Fed really wants to deal with inflation. And what does this mean for equities and bonds?
Well, I think, look, when we think about the equity market right now, and primarily if you look at the U.S. market, we still believe that the U.S. equity market is a bit rich relative to our fair value estimates, which takes into account, inflation and interest rates. So we think U.S. equities are still somewhat overvalued. But when you look at the international markets, we do believe they offer more value for investors. So when we think about the next 10 years or so, we're thinking that U.S. equities are going to return somewhere in the neighborhood of about 4.5% per year for the next decade. But international equities, because valuations are so much lower, are probably going to produce somewhere in the 7 to 7.5% type range. So there's definitely opportunities out there. You have to be a little bit more selective.
That's an interesting call on international equities going forward. But I just want to go back to your point about U.S. equities still looking a little bit rich to you. So how much more of a drawdown do you expect to see at this point?
Well, if you were to take a look at where we think about fair value, if U.S. equities would go back to the top end of our fair value range, you're talking about another 5% or so. If they were to get into the midpoint of our fair value range, you're talking to closer to 10 to 15%. So there could be some more pain, but it depends on how aggressive the Federal Reserve is and also how the economy ends up shaking out over the course of the next few months.